Welcome to This Explainer. Today, we're unpacking an absolute masterclass of an essay by Cern Basher. We're looking at a concept that fundamentally reshapes how we think about wealth building. Because, we often think investing is all about raw intellect. But we're going to see why patience, when you actually understand how to use it, is a massive competitive advantage. So think about this for a second. It's kind of the ultimate mystery, right? If investing is just a pure contest of intelligence, why do so many wildly smart investors fail? We're taught that the person with the fastest information, the most complex financial models, and the sharpest industry insights is obviously going to win. And sure, those advantages absolutely matter. But here is the catch. They aren't always enough. Time and time again, we see incredibly smart people, armed with the best data in the world, walking away with terrible returns. Why does that happen?
Well, that brings us to Section 1. Intelligence is not enough.
It's literally one of the most frustrating paradoxes in finance. You can do the work. Your analytical work can be completely flawless. You perfectly identify an exceptional company, you totally understand its competitive moat, you nailed a future earnings estimates, you were right. Yet your actual investment outcome can still be a total disaster. Why? Because you sell too early, or maybe you trade in and out too frequently. The analysis was spot on, but the outcome was wrong, simply because, you lacked the emotional endurance to let the thesis actually play out. Let's dive into Section 2. The reality of compounding. So looking backward, every great investment looks painfully obvious. The hindsight chart is this beautiful, smooth, orderly line going straight from the bottom left to the top right. The narrative just feels like inevitable success. But the lived experience, it is entirely different. Honestly, it's terrifying. The actual day-to-day path is filled with violent declines, years of total stagnation, earnings misses, and constant media headlines screaming that the company's best days are over. Even businesses that eventually become total global monopolies spend long stretches looking completely broken. To really get why this happens, we have to look at the math of backloaded compounding. In the early years, phase 1, a company is reinvesting pretty much everything. They're building massive factories, training new AI models, expanding distribution. The intrinsic value is growing, for sure, but it doesn't show up as cash flow yet. Then comes phase 2, this long, super frustrating consolidation phase where the stock just goes nowhere. But listen, if you sell here out of sheer boredom or disappointment, you're abandoning the asset right before phase 3, the harvest. That's the magical moment when the platform hits scale, operating leverage kicks in, and the economics just become truly explosive. And this leads to a crucial realization. The greatest returns arrive in very, very few moments. A company can literally spend years building value that the market completely ignores. And then suddenly, bam, within a tiny window of trading days, the stock rapidly reprices. Basher actually points out that the overwhelming majority of Tesla's massive historical gains happened during a tiny fraction of its trading days. If you try to jump in and out, trying to brilliantly time the market and avoid declines, you run a massive risk of missing those sudden, unforeseeable days where the real wealth is actually generated. All right, moving on to Section 3, time horizon arbitrage. This is a game-changer concept. Time horizon arbitrage doesn't mean you somehow have faster or better information than Wall Street. It just means you have the willingness and the ability to evaluate information over a much longer timeline than everyone else. When you have a truly long-term orientation, you don't need the market to agree with you today. That short-term volatility, it transforms from something you're terrified of into a structural advantage you can exploit. Now, why does this arbitrage even exist? Well, because the market is absolutely packed with people operating under completely different constraints, people who are literally forced to sell. Think about it. You've got day traders reacting to minute-by-minute charts, mutual fund managers sweating bullets over their quarterly benchmarks, hedge funds facing massive client redemptions, or even just retirees who legitimately need dependable cash withdrawals. They're selling for perfectly rational, personal reasons that have absolutely nothing to do with the long-term value of the business. And as a genuinely patient investor, you get to sit back and take the winning side of all those forced trades. We all kind of have this weird itch, this feeling that our returns have to come from our own sweat, right? Searching for trades, reacting to today's headlines, constantly tweaking allocations. That is what we call active interference. But in a truly exceptional investment, the heavy lifting shouldn't be done by you. It should be done by the business itself. Step back. Let the natural productive forces take over. Let the engineers improve the products. Let management allocate the capital. Let network effects grow, and let costs decline with scale. You don't manufacture those gains. You just have to hold on while they happen. Which brings us to Section 4, engineering true patience. Here is the thing. Patience is not just some personality trait or a matter of willpower. A brilliant long-term thesis offers you zero protection if a market crash forces you to sell just to meet a margin call or pay your rent. You actually have to financially engineer your patience. That means building adequate cash reserves, strictly limiting your portfolio leverage, sizing your positions appropriately so one bad drop doesn't wipe you out, and diversifying across different types of businesses. Capital preservation isn't some separate strategy from compounding. It's the very foundation that allows you to survive turbulent times so the compounding can actually happen.
But hey, to be clear, inactivity is not the same as neglect. I think patience sometimes gets confused with just being passive, but they are incredibly different things. A passive investor just buys something and stops paying attention. A patient investor continues to rigorously study the business while consciously resisting the urge to click sell without a fundamentally good reason. You still absolutely have to monitor if revenue growth is healthy, if margins are moving in the right direction, and if that competitive moat is still intact.
And that leads directly into our final point. Section 5, conviction versus stubbornness.
We need a massive reality check here. Blind faith is not patience. It is literally just speculation. Look, it is super easy to just tell someone, hey, be patient. It is so much harder to ensure that your patience is actually rational. The ability to sit calmly while a stock drops 50%, that has to be earned. You earn it through deep, rigorous, undeniable research. You need to know exactly how the business makes its money and exactly what could permanently damage it. Only then can you separate temporary market pessimism from a company that is permanently broken. So when the market crashes and your screen is bleeding red, the correct question to ask yourself is not, oh no, has the stock gone down? The stock going down is just noise. The only question that actually matters is, has the long-term economic thesis changed?
Well, how do you know if the thesis has changed? You have to look for specific, fundamental red flags. You reevaluate if you see a real loss of competitive advantage or deteriorating unit economics, chronic shareholder dilution, a decline in customer value, reckless capital allocation by management, or technological obsolescence. If those things are happening, then your patience has officially mutated into stubbornness. You never hold a deteriorating business just for the sake of holding it. Because remember, time only magnifies the economics that already exist. It helps strong businesses get stronger, but it will absolutely allow weak businesses to rot.
Ultimately, you have to separate the scoreboard from the game on the field. Stock prices are highly visible, highly emotional scoreboards, but in the short term, they are notoriously unreliable measures of what is actually going on inside a company. A stock price can plummet just because interest rates ticked up, or an index rebalanced, or some massive fund was forced to liquidate. Meanwhile, the underlying game, the actual business itself, is quietly lowering its unit costs, gaining millions of users, and building new factories. Sales, earnings, and competitive positioning matter so much more than the manic daily stock price.
Which leaves us with this final, crucial question: to rethink how you approach the markets every single day. Are you managing your portfolio to satisfy today's noisy scoreboard? Or are you actively engineering the structural and emotional endurance required to harvest tomorrow's exponential growth? At the end of the day, the greatest advantage doesn't belong to the investor who thinks the fastest. It belongs to the investor who can think clearly, act selectively, and then wait longer than everybody else. Thanks so much for joining me for this explainer, and I'll see you next time.